Hello, my name is Caleb Lopez, and I'm Chief Investment Officer at University Wealth Advisors, LLC. Today we're going to be discussing frequently asked questions that I get as a financial advisor. The first frequently asked question that we're going to discuss is, what does a financial advisor do? The best short summary of what a financial advisor does that I've ever heard comes from Carl Richards from the Kitces and Carl podcast. His definition of a financial advisor, or as they like to call it, a financial advisor, is somebody who provides financial advice and helps you align your use of capital with your stated goals. Everything a financial advisor does, from investments to financial planning to wealth management, can all be conceptualized in helping you, the client, align your use of capital with your goals. The next frequently asked question is, how do I know if I need a financial advisor? Usually when somebody asks this, what they're asking is it worth the cost to hire a financial advisor, or should I try to do things myself? The best parallel I can make with a service industry is with a mechanic. Have you ever asked the question, do I need a mechanic to work on my car? I think the answer to that question is very similar to how you would answer the question of, do you need a financial advisor? It all boils down to this. Do you want to do the things that a financial advisor does for your own situation? Or is it more worth your time and worth your headache to outsource that work to somebody else? For me, I'm not interested in learning how to change the oil in my car or to perform routine maintenance on any of my vehicles. So for me, the question is a no-brainer. I should hire a mechanic. I think you should think about hiring a financial advisor in the same way. Another frequently asked question is, how do financial advisors get paid? In the finance industry, there is a long history of different types of financial advisors and different types of compensation that they earn. The two main forms are transaction or commission-based or fee-based. A transaction or commission-based financial advisor is someone who makes money only when you purchase an investment or product from them. This could be selling life insurance, annuities, or it could be a broker selling you stocks, bonds, or mutual funds. A fee-only advisor, on the other hand, is somebody who only makes a flat fee that they disclose to you in advance to perform services on your behalf. This is what a fee-only advisor would be, or a fiduciary advisor. While there is a place for both, currently in the industry, we're seeing a large migration of clients who hire fee-only advisors. And they feel that when their advisors' interests are aligned with theirs, it helps create a more transparent and successful client-advisor relationship. How often should I meet with my financial advisor? Every office or practice is going to have a different standard operating procedure for client meetings. Some meet once a year, some meet twice a year, some meet 4 times a year or quarterly. I would say at minimum, you should be meeting with your advisor at least yearly, and anytime you have a major life event that could change your goals in your financial situation. I typically meet with my clients twice a year because that is a very good amount of time in order to accomplish everything that we need to accomplish without bogging down the client with too many meetings that at some point become less and less productive, and we're pretty much meeting just for the purpose of meeting. I also think that keeping a longer pace in your meetings helps you shift the focus from the markets day in and day out or quarterly, more on the long term of what we're trying to accomplish. What is your investment philosophy? While I don't think that I've ever actually received this question, it is something that you should be asking your financial advisor or me if we ever meet. I always tell my clients our investment philosophy is strategic rather than tactical. Strategic investing means investing for the long term, using long periods of time in order to make our decisions with academic research that backs up our recommendations. Tactical is going to be more short-term focused, trying to take advantage of any movements in the economy based on what you think or what the advisor thinks is going to happen in the next quarter or year. We feel for the clients we serve that strategic makes more sense than tactical, and the risks associated with tactical investing can be minimized when taking a strategic approach to our investments. I would say the most frequently asked question that I get is this question: what's your take on the market? I hate this question. I never get it professionally. I only ever get it in my personal life with people who hear that I work in finance. For example, my barber. I love my barber. He's probably never going to see this, but he always asks me every month when I get my haircut, what's your take on the market in these next 7 to 14 days? And I'm like, that is an impossible question to answer. I have no idea what is going to happen in the market in the next 7 to 14 days. I don't know what's going to happen in the market ever, because the truth is, nobody does. Markets can only make decisions as economic information releases. And markets are so information efficient that when a new piece of information comes out, I hear about it at the exact same time everybody else hears about it. That's why we have a strategic and not tactical approach to investing. Because at the end of the day, it's very unlikely that I could profit off of any new information that comes out quicker than Merrill Lynch or Morgan Stanley. So getting the question, what's your take on the market, is perhaps the most common, but also my least favorite. Another trending topic that I commonly get questions about is cryptocurrencies. A lot of people will ask me, should I invest in Bitcoin or should I invest in XRP? The cryptocurrency space is very, very interesting because from a historic perspective, it's very new. I think Bitcoin came out in something like 2008, and equity markets have existed for literally hundreds of years. So from a strategic perspective, it's very, very hard to make decisions about an asset class when so little information exists about how it acts in various economic environments. I typically tell clients who are interested in cryptocurrency that if you are going to invest in it as an asset class, you should only do so with funds that you are willing to lose, and funds that you are not expecting essentially to retire on or that you would need for some other important financial reason in the future. Me personally, I have a very small allocation in my retirement fund to Bitcoin purely for speculative reasons. I'm interested in following the asset class as it develops, but I'm not yet willing to make formal recommendations with my clients' money. Because AI is such revolutionary technology, a lot of people have asked the question to me, and more broadly speaking, does it make sense to invest in AI in order to generate returns? This question can be a bit more complex, so I'm going to break it down in a way that hopefully is easy to understand. There's a difference between investing with and in AI. Investing with AI would be using AI technology in order to trade in the markets generally. This could be trying to get information understood and digested more easily. This could be using AI's predictive powers, I suppose, in order to place speculative trades. So this would be an AI-powered trading or investing with AI. Now, investing in AI is going to be separate from that. That's going to be investing in companies, whether that be through equity securities or other forms, in order to try to generate off of the popularity and potential success of AI as a technology. This may or may not be an easy thing to do. So for example, ChatGPT's parent company, OpenAI, is actually a privately held company. The people who invested in that had to be accredited investors, and they had to purchase into an investment pool for that company on a private basis. This means that likely a hedge fund or some type of private equity firm facilitated the transaction into this company. You or I could not just walk down to OpenAI headquarters and say, I'd like to purchase 100 shares of your company. Investing in private markets is still relatively difficult, and it is selected for those who have disproportionately larger assets. So if you can't just walk down the street and invest in OpenAI, how would you invest in AI? Ironically enough, it is the larger and already more visible companies that you know and may already be invested in who are developing AI products. Apple, for example, came up with their Apple Intelligence platform, which I believe works with Siri. Microsoft purchased a large share in OpenAI, ChatGPT's parent company. So if you were already holding Apple and Microsoft in your portfolio, you would, by proxy, already be investing in AI. Depending on your risk tolerance and whether or not you're an accredited investor or not, investing directly in AI may or may not make sense. And for the majority of people, it may just be best to allow your holdings to develop that research and that technology on its own, and you take advantage of it, but more passively.